Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. It's comeback for stocks, rallying after Friday's tough sell-off. At the end of the session Monday, all major indices did end the day higher. And we're headed into earnings season. Retail traders are paying attention. We're speaking with an expert from Stocktwits on trading trends, risks, and rewards. And it may be a tale of two wallets when it comes to American household spending and credit card use. We're breaking down some important differences and similarities in consumer habits. Well, retail traders remain broadly optimistic about markets heading into year end, but traders keeping an eye on key risks as earnings season comes into view. Here to discuss this and a whole lot more, we got Tom Bruni, head of markets and retail investor insights at Stocktwits. Tom, always great to see you, especially on set. I like how you say this, Tom. You say retail investors, you say they've had one foot out the door for the last several weeks. Why? Why one foot out?
Yeah, I think it's been a big theme throughout the year. Obviously, we have the tariff tantrum, and the market has been climbing this wall of worry, so to speak. And so there are a lot of potential risks out there, a lot of things that could have moved.
What would be on your
lower.
wall of worry? What's the risks?
We've got geopolitical headlines, we've got a weakening consumer, we've got the labor market.
Jay Powell says we're stretched.
Exactly. So I think there's been a lot of things that retail and investors in general have been worried about, and it just really hasn't gotten the market reaction. So people were wondering, what is going to be the risk that we don't see? You know, a lot of the things that we've talked about, inflation, unemployment, what the Fed's going to do, geopolitics, are all well known. And so the key question was, what's going to make the market actually jump?
Well, that's what I wanted to get to you. If they have one foot out the door, my next question to you was, what would cause them to jump fully out the door?
Yeah, I think a lot of the optimism we're seeing around the AI plays is really hinging on spending in that area continuing. This coming earnings season, we're really looking for that guidance to show that, hey, Mag 7 stocks.
Spending boom continues.
Yeah, like we're not concerned about the macro picture, China, blah, blah, blah. We're focused on, building out this infrastructure. And really what retail wants to see is some sort of sign that we have real earnings or real revenue coming from these areas. I still think
in other words, at some point they'd like to say, where's the margins?
Exactly. Yeah. So I think that's what the market is waiting for. That might be the next hat to drop in a sense. But I think right now retail is saying, I've been rewarded for taking risk, and so I'm going to continue to do so, but I'm going to keep my risk measures and risk management close by in case I need to get out.
Bottom line though, would you say the Stocktwits community is, would you say broadly, having said all that, generally optimistic into year end in 2026?
Yeah, definitely. They're sticking with the core themes that really aren't affected by kind of this geopolitical stuff coming out of China. I think there's been a bit of change of heart around some of the Chinese names, Alibaba, et cetera. Maybe they're not as aggressive in adding on the dip here for those names, but the broader infrastructure stuff, we've saw a ton of energy names moving today, the rare earth side of things. Yeah. This is a broader theme that basically the U.S. needs to figure out on its own, and so any company with ties related to that is catching a bid in a big way. And the second piece is, central banks around the globe, the Fed, they're basically saying, hey, we need to stimulate growth at the risk of inflation. So we've already seen a lot of other central banks start to ease. The Fed is now starting their cycle. So if you think about kind of this global debasement trade of fiat currency, people are looking to gold, they're looking to precious metals in general, they're looking at crypto as ways to protect or hedge against that potential debasement that's coming.
Let's talk about earnings season. We've heard from some names, but now, Tom, we're going to get right into the thick of earnings season. Right? Got big banks on deck. I'm curious, what are the big themes, the trends you're going to be listening for?
Yeah, I really want to see some earnings growth outside of tech. I think financials have started to show some. Industrials are doing well. There's even some in healthcare. So I think we want to see a broadening out of earnings. Obviously, we're relying a lot on the Mag 7. They're generating a ton of cash. but the market is kind of hinging on those big names. So it would be nice to see kind of the earnings picture broaden out. I think this is a great environment for financials. We have the rates coming down. The curve is still steepening, so that's great for them. We've got industrials in terms of the infrastructure play and defense that should do well. So I think there are broader pockets of the market that are doing well, but again, retail is really focused on kind of the high octane AI infrastructure plays that have been working.
Let's talk about what they're focused on, because I always like to hear what the Stocktwits community, I like to hear what's interesting in them, what's exciting them, what are they buying.
Yeah.
Here's some names on their radar: NVIDIA, Palantir, Robinhood.
Yeah, I mean, these names are all retail favorites in terms of building their core portfolio. And then when you move beyond that to some of the more speculative names, you're looking at like TMC, SMR, Oklo, the nuclear energy names, the rare earth metals, the lithium battery plays. They're looking to kind of these ancillary industries that basically are now in the crosshairs of this geopolitical tension between the US and China. China has a bit of a monopoly on this industry, and so the US needs to figure it out. So any company that has some sort of US tie that could support this industry long term is catching a bid in a big way.
Those names you just rattled off,
yeah,
well-known names, are there some common themes and trends that you would say unify that basket you just called out?
Yeah, I think it's the narrative in general, right? There's kind of this need for energy independence, energy infrastructure in the US, and so it's not just going to come from oil and gas, it's not going to come just from solar. I think there's a broader theme here that both the administration and investors alike are seeing, that if we're truly going to see this much AI demand for energy, it's got to come from all sources and not just one. And these have been underdeveloped, underfollowed industries for a long time, and it seems like it's happening in a snap, because quite frankly it is.
Fire. What about crypto? Still exciting on Stocktwits?
Crypto is definitely interesting. Obviously, we had that big sell-off on Friday. I think there's an important caveat here. Crypto is still a risk asset. Yes, it's a hedge against the debasement trade and fiat currency, and there are some use cases in the real world, but really it trades like a risk asset, and I think we saw that with altcoins selling off. It's a source of liquidity. The market closed on Friday at 5 p.m. There were still jitters about the tariffs, and so we saw kind of a lot of leveraged bets in the crypto market get wiped out. So I think Friday was a wake-up call for a lot of retail that maybe had gotten sloppy with their risk management in terms of how far out on the risk spectrum they had gotten. With that being said, they're still very bullish on the majors. So Bitcoin, Ethereum, Ripple, even Solana are all kind of longer term plays that they expect to move higher, but definitely in the short term, the momentum is broken.
What are the levels you're watching on Bitcoin?
Yeah, Bitcoin, I think the lower end of the range is like 108, 110. Ethereum, it's about 3,900. So if we can stabilize above that, I think it's an important technical level to show that the momentum hasn't completely broken. Really though, what we need to see is Ethereum, Ripple, and Solana break above their 2021 highs to really show that there's altcoin leadership and that there's sustained momentum in this rally.
Tom, always great to see you and to have you on set.
Thanks for having me.
Stocks soar as Wall Street rebounds from a tariff-fueled rout. The S&P 500 and the NASDAQ coming off their worst days since April. Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
Thank you, Josh. We got to talk about this comeback. Stocks were surging. Bonds took a nap because it was the bonds day off. That's the nature of the beast when we have a bond market holiday. But I was really fixated on some of this outsized price action. You take a look at this. This is very impressive. Tech is up 2.4%. You take a look at the NASDAQ 100. Tesla's up 5%. Broadcom almost 10. Alphabet 3%. But I will say, when you take into consideration the losses that we saw from Friday, and this is a 2-day view, you see a much different picture. So I'm not saying that this this may be over, it may not be. And it all comes down to whatever headlines we get out on the tariff front that really kind of complete that picture for us. Only utilities, which by the way, XLU hit a record high today, only that is in the green. Tech is still looking at losses of 1.7%. Here's the semiconductor space. You do see some green here, especially Taiwan Semi and Broadcom. Even China, kind of the heart of the action here, a lot more red, really not a lot of green at all. So this was an important day, but I would also stress that on a bond market holiday, you're not going to have a lot of traders at their desks, and it's easy for things to go up. And so it's going to be key to see this week if we get some follow through to the upside, or if we roll back over. Turnaround Tuesday could easily be turned down Tuesday.
Let me ask you, I mean, do you look at Friday's tariff news and think, okay, maybe not such a big threat?
Well, I asked that very question to Brian Levitt today on Stocks in Translation. He's a friend of the show, and we were talking about CPI too, because we do get CPI for the month of September. It's going to be October 24th, so a bit later than we expected, but that's coming around the corner. But he kind of broke things down with respect to inflation and had this to say.
So it's no surprise to expect to see headline consumer price index back up above 3%. Our expectation is that it'll continue to climb over the next 12 months. That's the base effect of a tariff. If your washing machine used to cost you $100 and there's a 25% tariff on it, it's now going to cost you $125. That's your one-time price increase. The bigger question for the market is over the next 3 years, does that price of the washing machine keep going up? And that's where the bond market is telling us, no, that is not the expectation.
So Brian's basically telling us that the bond market, its fears over inflation are pretty muted right now. We'll have to see if we see some kind of divergence in the future.
Any other records to call out?
Silver is now greater than gold on a couple different metrics. Finally today, at least on my futures data and Yahoo Finance data, you can measure the rollover and futures contracts a little bit differently, but silver finally exceeded its 2011 high. And let's just put a max chart on here. Goes back to the beginning of the century, and boom, finally took that out. It only took, 14 years? So it's been an incredible run. And I'll tell you what, you take a look at the year-to-date performance in these futures here, and guess who takes the gold here? Platinum takes the gold, up 85%. Silver takes the silver. Palladium takes the bronze, I guess. And then look at gold in fourth place, 55%. But I think you get a ribbon for fourth place, right? There's no medal.
It's Monday.
Yes.
Let's talk Bitcoin.
Let's do that. Friday did some damage to Bitcoin. This is year to date. I'm going to dial this down. Let me actually just show you a 5-day so we can incorporate what happened Friday as well. So Bitcoin net down about 5%. However, if I look at the year to date here, we are still in this trading range. Remember how I was saying, well, Bitcoin kind of famous for its false breaks to the upside and the down. This was a false break to the upside with perfect hindsight. So was this. So as Tom Bruni was just saying, 108, 109,000. That's really my line in the sand here, and we'll just have to see. As long as we bounce around in the middle there, probably just more range-bound stuff.
All right, thank you, buddy. Appreciate it. Bank of America's latest consumer data tells a tale of two wallets in America. Spending is still growing, but it's being driven mostly by higher income households. For more, we're bringing in now David Tinsley, senior economist at the Bank of America Institute. David, it's good to see you. So your report calls this a tale of two wallets. David, explain that trend for us. What is the divide like right now between high and low income consumers, and what's driving that?
Well, it's quite wide. So the overall picture is solid. Spending across the US in our data up 4 months in a row, 0.2 month on month in September. But digging just beneath that, high income consumers, their year on year spending growth, card spending growth, 2.6. Lower income consumers, that's the bottom third of households by income, just 0.6. So there's a real divergence. It's pretty wide, at least as far back as since the pandemic. And I think the main reason, there are a couple of reasons, but the main reason I think is wages. When we look at our data, the pay going into people's accounts, this is a very broad data set. We have 69 million consumer and small business customers. When you look at that, high income wage growth, 4% year over year, pretty solid number. Lower income consumers, households growing at 1.4% year over year. And that divergence has widened really over the last 6 months or so. So that's, I think, the primary driver.
What if the stock market, David, suffered a pullback or even a correction? What could that mean for high-income consumers?
Well, that's an interesting point. Wealth is very skewed along the income distribution in the US, obviously in many countries as well. What that means is a lot of financial assets linked to the equity market are held by the top end of the income distribution. And when we look at our data in detail and we look at the spending growth of just the top 5% of households by income, we see quite a close relationship in recent years between what the S&P has been doing and how much their spending is outrunning the middle of the income distribution. So I guess what that means is all the time the equity market remains roughly where we are. Higher income spending growth should remain solid, intact, still outgunning the middle income pack, if you like. Obviously, if there were a correction, we might see some softening there.
We've been talking here, David, about high-income consumers and low-income consumers. What does your report tell us about the health and resilience of middle-income consumers right now?
Yeah, I think that's reassuring in a way. So really, in many ways, literally the middle are in the middle in this data. So in terms of wages, they've seen a pickup somewhat more closer, slightly below, but somewhat more kind of correlated, if you like, with the higher income consumers. Their spending growth is pretty much right in the middle of higher and lower. So, and I think that is important because basically middle income and higher income together, you're talking there probably 80% or so of US consumer spending. So if these cohorts stay intact and don't weaken, then the overall economy, notwithstanding the fact that things are difficult at the bottom end, can look okay.
We've been talking a lot on this show, David, about the cooling labor market here. If that continues to cool, I'm curious how as an economist you think through the impact on the consumer.
Yeah, well, we've in the absence of official data, in part, we've been looking at some of our labour market data, obviously, quite closely. And what we do see in our data, when we look at accounts receiving paychecks, gives us sort of a guide to payrolls. We have seen some softening there. The year on year in that data series was 0.5 year over year. So indicative of continued slowdown in the labour market. You might expect eventually that to impact wage growth. And when and if that does, then you would expect to see some consumer spending slow down. But as we were discussing, really right now, higher income, middle income wage growth looks okay. So I think in a way, this isn't an incipient problem coming down the tracks, but it might, we have to watch carefully how things develop over the next 6 to 12 months there, I guess.
What about tariff impact, David? I'm curious, where, if at all, do you see that showing up in your data?
Well, we see a little bit of impact. So when we look at durable goods, so the kind of things that you might expect to be impacted because they've got a high import content by tariffs, what we see is that the number of transactions that are occurring per household are weaker than the dollar value. So in other words, there is a little bit of a price effect coming into the spending calculation that consumers are facing. But what I guess I would say is that it's relatively modest and relatively gradual over time. So I think very much kind of consistent with what we've seen in the CPI data, and I think heard as well in terms of kind of news flow. This effect is coming through, but it's not coming through all at once.
The Fed meeting coming up later this month, David. Investors expect the Fed to keep cutting. What does that mean for the consumer?
In the short run, I don't think it means that much, I mean, how is a Fed rate cut going to impact the consumer? Well, one traditional channel is through the housing market. But we know the housing market, because of the locking effect, the fact that a lot of people borrowed at lower mortgage rates than the current prevailing rate, that means the housing activity effect from these cuts right now is relatively modest, if at all. Consumers can borrow more from home equity lines of credit against the equity they've built up in their home. And we have seen some evidence of that. but that's not a major impact on overall consumer spending. So I kind of think right now this is a fairly modest effect, direct effect on consumers onto consumer spending, and more of an indirect effect will eventually come via the labour market.
David, always great to see you and to have you on the show. Thank you.
Thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.